January this year, we were looking at GDP growth for Nigeria projected at 4% for this year. A few months down the line, those projections had been revised to suggest that this economy would shrink by as much as 2% this year. In other words, a 6% swing. Believe me, when people talk about contraction, that's bad. But that kind of swing is really what kills an economy. If you talk about well-being, economic well-being, it had to become immediately apparent that such a shift would create unemployment. It had to become immediately apparent that such a shift would undermine confidence. And the key question then becomes, how do the institutions of policy react? The last MPC was probably one of those opportunities when the central bank could have reacted. For once, Tokwe and I share the same position, that the central bank, in my view, I'm a minority in this view, reacted wrongly. Tightening in anticipation or in order to attract liquidity, foreign currency liquidity, was, in my judgment, an error. Nigeria must increasingly understand that this is not the 1970s when we were not well integrated into the global economy. In the years since the 1970s, Nigeria has actively sought, let me repeat that, Nigeria has actively sought to become a member of the global economy. There are 4 dimensions or 4 domains that I usually worry about in international economics or the international economic environment as far as Nigeria is concerned. The first, I worry about international policy, especially these days, monetary policy. The second, I worry about international trade, and largely because oil and imports are important to Nigeria. By the way, when people say Nigeria is import dependent, I think that's absolutely nonsensical. This is a $500 billion economy that imports less than $60 billion a year. What is important is that the nature of the imports have become such that our manufacturing industry, our construction, quite a number of sensitive industries cannot move without imports. So you can argue that, if that's the case, then you're import dependent. It's only because we have chosen to do nothing about it. Coming back to the point about welfare, if your economy is going to swing like that, and you spend the previous 18 months berating foreign portfolio investors, foreign domestic, foreign direct investors, what do you expect? So now we raise interest rates, and we expect them to say, our sins are forgiven. Or we are saying to them, their sins are forgiven, they are now welcome. We are forgetting it is them who will have to first forgive our sins. I have no hesitation in saying that whether we like it or not, Nigeria is a savings deficient economy. And because of that, we do require foreign capital. You cannot put an infrastructure master plan on the table which argues that over 30 years, Nigeria is going to invest $3 trillion to upgrade and expand infrastructure. Do you know how much that is? Over 30 years from 2013, Nigeria is budgeting an average annual spend of $100 billion. Add all state, federal budgets together, they don't come anywhere near that. Tops, we are talking about 13 trillion naira. 6 trillion at the federal level, and tops 7 at the states. By the time you've added all of that together, it doesn't, even if they spent all of it on infrastructure, it really does not come anywhere close. Please note what I said. If all the monies that the states and the federal government budget go into expanding infrastructure and upgrading infrastructure, it doesn't come anywhere near the amount that we are projecting to spend if our infrastructure is to come up to the state where it supports our economy and makes our economy competitive. So if that is the case, what is very clear, very obviously clear, is that we are calling for a private sector solution. Private sector resources must come to the table. And if private sector resources must come to the table, then the nature of our language, the nature of our policies, the articulation thereof becomes important issues to reflect upon. One of the missing links in Nigeria's policy making is the need to handshake monetary and fiscal policy. Let me repeat that. The need to handshake monetary and fiscal policy. If you look at the Central Bank Act, it actually does try to do that, because the Permanent Secretary, Ministry of Finance, is a member of the MPC. But then, in recent times, there has been no representation at MPC meetings by the Ministry of Finance. The board of the central bank has been dissolved. I know that the process of its reconstitution with those of other boards of other public parastatals is ongoing. But there has to be a handshake between fiscal and monetary policy. Monetary policy must take the assumptions of fiscal policy into consideration in making its own policy decisions. Nigeria needs to make up her mind and articulate whatever she decides as to where her direction lies. We used to do development planning. Today, nobody in this room, I suspect, can tell me what the priorities for 2018 are.